Okay, and welcome back in the next video, Smart Money Concepts Part 5, SMC Bull and Bear Patterns. And why are they so important? Because they are the basis of our setups, of our scalps, our day trades, and even of swings. Now I'm gonna draw a bunch of patterns, and you guys will already, if you follow the videos, you will start to see a pattern inside the pattern. So we have a higher high here, a higher low, a higher high, a higher low. It's a bullish trend, as you can see. And in smart money, we are trading always with the trend. We are entering here, taking profits here or there. And as long as the trend continues, he is your friend. We always say in trading, the trend is your friend till the end of the trend. Now, that means exactly, and we've seen this with breakout structures and market structure shifts. So suddenly price comes down, goes back up, comes down, goes back up, comes down, goes back up, comes down. And these things happen in smart money concepts and in ICT too. Now, let's analyze quickly what this is. You can see we had the breakup structure here. Wasn't the right click. Okay, again. I was a little distracted, just got a call, but I put it off. So we have a breakup structure here, 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 and then we get a market structure shift because the latest higher low has been broken. And with this market structure shift, you can see clearly now that here we don't have a new breakup structure. And this could be already an entry model where we're gonna enter in a fair value gap in an imbalance with a stop above the high and targeting the latest lows because there's always resting liquidity below old lows and above old highs. In this case, we don't have highs because the breakup structure always took out the liquidity of the highs. Now, because liquidity is resting here or laying below here, we call that, by the way, I'll show this. I call this, I have it in my templates, sell side liquidity because there are stop losses here of long positions, and if they get mitigated, the stop losses, they become sell orders. And that's why I call it sell side liquidity. And the buy side liquidity for me lays above old highs because there's buy stops and stop losses from shorts, and they're internally accumulated. The market puts one order with another together with another. So when a stop loss is hit, that's where somebody probably gets filled on his buy stop. You get different types of orders, market execution, buys or sell limit, buy stop or sell stop, and even buy. There's more types of orders. We'll get into it later because it complicates only what we're trying to educate on for now. Now, in this case, we would have an imbalance here. And if we would get in the first leg, once we see the market structure shift, Sometimes price comes down, goes back to your break-even point or in drawdown, goes back into profit, back into drawdown, mitigates the whole fair value gap, and comes down. In trading, nothing is sure because we are building liquidity here, and possibly we are forming a fair value gap here with an order block on a lower time frame that could result in a stop loss getting hit. And it just provides you of data. Like I said in older videos, there's no such thing as losing. There is only winning in trading, because or you have a TP hit, or you get out manually with profit, or you get data for your journal. And if you analyze the data, you apply the results of your data in your trading, you get a better trader. So it's always a win-win-win situation. Losing some money is going to be something that happens in trading. I blew up many accounts, like a few live accounts with my broker, and like several funded accounts with funding providers. I use a few one, but I'm not gonna make ads for them. That's not the purpose of my videos. But this can happen also in the other way around. Let's quickly clean the screen. The breakup structure, we can leave it. The fair value gaps, let's take them away. We're gonna need this. So we started with an uptrend. Now we start with a downtrend. And the smart money pattern shows you this. So, okay, let's get this a little to the side. Okay, perfect. We can see we have a break of structure here. We have a break of structure on this level. And now for our entry model, we are looking for a market structure shift. Now imagine we're looking on the 5 or 15-minute time frames, then this isn't a valid market structure shift. This wouldn't be a valid market structure shift. The valid market structure shift would only happen here. But if we would go to a lower time frame, then we're on the 15 minutes, let's say, and we check on the 1 minute, then it can be that we have a fractal market structure shift here. And this could be our entry model for a long position then, where we enter in the fair value gap, let's say here, and we go again, we're gonna target the latest high, and you see how quickly we get a 1-to-2 risk reward ratio, 2.5, and even 1-to-3. Now, like in the last video, sometimes price comes back down, takes you out first, and then goes in your direction. It's just trading. And you'll get used to it. The more you practice, the more you know where to enter, how to enter, why to enter. Validate your setups, stick to your plan, stick to your setups, don't overtrade. And it's all experience, guys and girls. The more you spend, the more time you spend on the charts, the more you read order flow, the more you get acquainted with the market, the better you get. And it's not going to happen overnight or in weeks, but it takes time. So this was the video on smart money concept patterns. I hope you picked some things up on market structure and entry models. And see you in the next video. Give us a like, follow, share, and thank you.